Good morning, everybody. Thank you for joining our webinar in which we'll be running through yesterday's autumn statement. My name is Tim Stovold and I'll be your chair for today. I'm sure most of you are familiar with who we are, as I can see lots of regular names on the attendee list. However, for those of you who don't know us so well, Moore Kingston Smith is a top 10 audit, tax and advisory firm working with businesses across all industries, not-for-profit organisations as well as private clients. We're also part of More Global, an international network with presence in over 100 countries. So moving on to today's topic. After months of being told that there'll be no reduction in taxes due to tough economic conditions and high inflation, the run into the autumn statement saw hints at inheritance tax cuts, measures to make hard work pay, and changes to stimulate large-scale capital investment by businesses. The Chancellor started his speech by saying he had 110 changes in his toolkit to drive the economy forward, and we found out in the course of the speech that one of those, at least, was the most costly announcement a Chancellor has ever made in terms of changes to the tax system. Today, our expert panel will provide valuable insight in how yesterday's announcements will affect you and your businesses. So I'm delighted to be joined by Mel Reid, who's one of my fellow tax partners specialising in corporate tax and M&A tax, and Katy Shaw, one of our private client directors specialising in advising UK and international private clients on how the tax system applies to them. Questions can be posted in the Q&A function. Please use this rather than the chat function, as that helps me keep track of the ones who've answered. Given the number of people who've logged on, I'm hoping we'll get lots of questions throughout, and I've promised to keep the panelists on their toes with the questions on yesterday's content. We'll follow up the session with a summary of the key points and a link to the recording of the webinar. We'll also send back a feedback poll. So can I just make a plea to respond to this poll? So it really helps us shape these sessions in the future and make sure we cover the topics that are of interest to you. So with the admin over at the beginning, I'm going to start with Katy Shaw on private client matters. So I shall be quiet and over to you, Katy.
Thanks very much, Tim. Good morning, everybody. One of the key tax cuts announced yesterday was the reduction in Class 1 national insurance for employees. And currently the rate of Class 1 NIC is 12% on earnings between 12,570 and 50,270. But that is going to be reduced by 2 percentage points to 10%. And a surprise move is that that's going to be effective from the 6th of January 2024, so slightly earlier than what we'd normally anticipate. That saving will be up to £754 per person. And just to clarify, so that's a change to Class 1 primary NIC, so there's no change to secondary NIC that employers pay. It's a welcome move because it's going to affect a large number of people. It's going to benefit around 27 million people, but tempered slightly by the fact that for those with income that's non-employment income, so perhaps rental, property or investment income, then it won't benefit them, and also tempered slightly by the fiscal drag. Moving on to NIC changes for the self-employed, so 2 changes here. So the first of which is Class 2 NIC, which is currently payable at £3.45 per week. That is to be abolished completely from the 6th of April 2024. So the current benefit of paying Class 2 NIC is to maintain certain benefit entitlements, but the Chancellor confirmed yesterday that access to those contributory benefits such as state pension will be maintained. Voluntary contributions can still be paid for those that's relevant for. The second change for NIC for the self-employed is that Class 4 NIC will be reduced from 9% to 8% on profits between 12,570 and 50,270. And that's effective as well from the 6th of April 2024. So just staying on the theme of self-employed individuals, so there was an announcement yesterday to expand the cash basis of taxation that can apply for self-employed and partnerships. So the cash basis of taxation is a simplified way of calculating your taxable profits compared to the normal accruals method of accounting. At the moment, there's a threshold restriction. So if you're self-employed or in a partnership and your turnover is above £150,000, you can't report on a cash basis, but that threshold is going to be removed, as well as some other restrictions around loss relief and interest reduction. That's going to be effective from 6th of April 2024. It doesn't apply to LLPs and it doesn't apply to partnerships with a corporate member. And more substantial, much larger businesses might just prefer to stay on the accruals method of reporting in any event. Some big changes were announced yesterday in respect of ISAs, and the plan really is to make them more simplified and widen the scope available to savers. So some of the changes include multiple subscriptions are going to be allowed. So at the moment, if you invest, say, £20,000 into a cash ISA, the plan is that you can split that amongst different providers, providing it's the same type of ISA, so cash or a stocks and shares ISA. There's going to be no requirement to reapply annually. Partial transfers will be allowed, so you can take out part of your ISA and put it within another provider that you can't currently do. There's plans to digitise the reporting system to make it easier for savers to keep track of where their ISA funds are. And in terms of widening the scope, so there's plans to widen the type of investments that you can put into an ISA. So these will include long-term asset funds, open-ended property funds with extended notice period. So it just opens up things so that people can invest more in, say, private equity or property-backed investments. Fractional shares may also be allowed as well. So at the moment, you can't put a fractional share into an ISA, but going forward, if you want to put half a share in Apple, for example, then you should be able to do that. All limits remain the same. So it's £20,000 per adult, £9,000 for a junior ISA for children, and £4,000 on the lifetime ISA. So they're not changing. But one change that is going to come into place is that the adult ISA minimum age is going to increase to 18. Currently it's 16 and 17. So if you've got any 16 or 17-year-old children, then they can maximise the £20,000 this year. Making tax digital. So there was announcements yesterday following a consultation that the government will proceed in introducing making tax digital from 2026 for sole traders and landlords with income over £50,000. And the same change will come in a year later for those with that type of income above £30,000. So there's no need to join if you're affected until 2026 or 2027. But if you're so inclined, you can volunteer to join Making Tax Digital before then. And if you do, then you will be subject to a fairer penalty regime. There were some smaller details yesterday in the autumn statement about a removal of requirement for self-assessment for individuals who only have income that's taxable through PAYE. So if you only have a salary, then you don't need to submit a tax return. Currently, the threshold is £150,000 for that to apply, but that threshold is going to be removed. So it's a simplification measure that's welcome, but those with very high salaries are still likely to have to file a self-assessment tax return if they've got other sources of income, such as investment income. So yeah, so it might not be a simplification for those individuals. That's effective from 6 April 2024. Included in some of the detail as well yesterday was an announcement around improving the data that HMRC collects. So HMRC are going to require certain employers, directors, and some self-employed individuals to provide additional data to HMRC. And the reason for that is the slightly vaguely worded to enable better outcomes for citizens and businesses. So to give an example of that, so employee hours are going to need to be reported via PAYE. And also a change for the tax return is that if an individual has received dividend income, say from a private company or who's an OMB, they're going to have to report the shareholding percentage on their tax return. And that comes into place from 2025-26. And just before I move on to just a recap on the main tax rates, I just wanted to remind everybody about the pensions lifetime allowance. So you might remember in the spring 2023 budget, there was quite a big announcement made that the pensions lifetime allowance is to be abolished. And the limit at that point was 1,073,100. So, and what came into effect quite soon thereafter was the lifetime allowance charge was removed from the 6th of April 2023. So the government confirmed yesterday that the plans are ahead in terms of completing that work, and all the relevant legislation, all the detail around it is to be published fairly soon. And that will clarify for advisors and individuals affected the taxation of lump sums, lump sum death benefits, and also the tax treatment of overseas pensions. And that's going to come into place from 6 April 2024. So before I hand over to Mel, I'm just going to run through what the main personal tax rates are and confirm where no changes have made. So the main personal tax rates, so no changes here in terms of the tax rates or the thresholds. So yeah, there's a table there that just shows that. I'm not going to run through it, but you'll get a copy of the slides. Moving on to CGT, so capital gains tax rates. So no changes there. We weren't expecting any change, so nothing had been trailed in that respect. So CGT rates remain the same. So if you're a basic rate taxpayer, so when you look at your income and your gains that you made, if you're still within the basic rate band, you pay CGT at 10%, 20% if you're a higher or an additional rate taxpayer. The rate is higher if you sell and make a gain on residential property or carried interest at 18% and 28% respectively there. And no changes to the business asset disposal relief, which tax gains at 10% up to a lifetime limit of 1 million. And that mostly applies to sales of business assets. Inheritance tax. So in the press in the weeks leading up to the autumn statement, there had been speculation that there might be changes announced, but quite frankly, I think the government got cold feet on that. So there was no changes to inheritance tax. So that remains the same. The nil rate band remains unchanged as it has done for several years. So the nil rate band is £325,000 per person. And there's also a top up in terms of the residence nil rate band of £175,000 per person. That does get tapered away once your estate gets above £2 million. The headline rate of IHT is 40%, lifetime rate of 20% on transfers into trust, for example. And then finally, just a reminder on certain changes in allowances and exemptions. So at the moment, there is a dividend allowance, so you can receive dividends up to £1,000 tax-free with no need to report. That reduces to £500 from next April. Similarly, the CGT annual exemption, that has reduced now to £6,000. It was double that last year, and that's reducing again from April 24 to £3,000 per person. It's probably going to push more people into self-assessment, and I think because of these reductions, maximise those exemptions now and maximise capacity on the ISAs, given that income and gains made within an ISA can be received tax-free.
Okay, thank you, Katie. But I had one question in, and this is, I suppose, in the light of the speculation in the press today that we may have an early election called now, possibly early as May, which means we've got the spring budget, and the spring budget will be the last opportunity, whenever the election's called, for the Chancellor to make any further tax reductions or changes to the system. What does your crystal ball tell you may happen in the spring budget next year?
So I think there will be more tax changes if there is fiscal headroom to do so. The Prime Minister has previously said that he wants to reduce the basic rate income tax from 20% to 19%. And I think if the economic conditions allow, if he can achieve that, then that's something that he'll go for. Inheritance tax as well. So as I just mentioned, it was trailed in the press. I think the government got cold feet, but I think they're saving that potentially to the spring budget, and change there could be a decrease in the 40% rate or an increase in the nil rate band.
Yeah, both incredibly costly changes to the Treasury. I think they've stayed away from the basic rate of income tax because even changing small amounts to the rate do cost an enormous amount. So we hope the economy continues to power on. There's also the fiscal drag as well. I mean, there's lots of comment about the effect of fiscal drag on people. That's the main tax increase, which is the one that no one can really see in the rates and the threshold. So there's a lot to play for in the spring budget. So we move on so thank you, Katy, for that. And do please continue to send questions, and Katy will be able to tap out answers whilst Mel's speaking, and we'll have hopefully some time at the end to talk through some of them as well. But with private client done, we're going to move on to corporate and business, and I shall hand over to my fellow partner, Mel Reid.
Thanks, Tim. And good morning, everybody. So I'll be covering some of the corporate tax changes that were announced yesterday. There was actually not much announced in terms of what's happening in the corporate tax arena. So, but there were two key changes in terms of sort of capital allowances and also R&D. So I'll pick those up. So just to remind everybody, the corporation tax rates are remaining unchanged. On the 1st of April this year, they went up to 25% for most businesses. And you can see on the slide there, if you're a small business with small profits, then you're paying 19% still. So just moving on. So in terms of capital allowances, what was really welcome news was the announcement that full expensing for capital spend for companies only. So what this allows is all companies in respect of qualifying plant and machinery to effectively take 100% tax deduction for the capital spend. This is nothing new. It had previously been announced, but actually what the Chancellor's done is make it permanent, which is a real relief for businesses in terms of being able to plan forward in respect of their capital expenditure. I think one thing to note, it only applies to companies, not sole traders, partnerships or LLP. And you can see there on the slide that the Chancellor said he expected it to be a £14 billion investment, one of the biggest tax giveaways over recent years. So for those items that meet the definition of qualifying plant and machinery, you get 100% relief. For all other things, you will get a 50% relief. So it's things like integral features in buildings, so air conditioning units, etc., that you would normally get 6% relief for, and long life assets as well. So it is a real benefit for businesses, and it gives them some certainty over the future, certainly until the next changes are announced anyway. Of course, what it does mean is that if you then do sell that asset, you get a balancing charge on disposal. So effectively, if you buy something for £100 and then you sell it for 50, you'll get relief for the 100 in the year that you buy it, but you'll be taxed on the 50 when you sell it. Normally, what happens is it just effectively works its way through the capital allowance pool, but this will be an actual increase in taxable profits for those years. And as you'd expect, there's all sorts of anti-avoidance provisions that apply to stop businesses effectively manufacturing deductions where they're not entitled to it. One thing just to mention as well, that this only applies to new items, not second-hand items. And also it doesn't apply to businesses that buy assets and then lease them out. So it's really trying to target for businesses that are investing for their own purpose. So what about businesses that aren't operating as a company, whether you're a sole trader, a partnership or an LLP? So the normal rules still continue to apply. We've got the annual investment allowance at £1 million, which allows that business to effectively write off up to the first £1 million and get 100% deduction on qualifying plant and machinery. And thereafter, we've still got the writing down allowance that remains at 18% and 6%. I think there's quite a lot of call in terms of simplification. Why have one rate of capital allowances and regime for companies, and why have another rate for partnerships, LLPs and sole traders? And I think quite simply, the cost of introducing full expensing for sole traders and partnerships, where you're effectively getting tax relief at the highest rate of profit, so up to 47%, rather than 25% for companies, is probably, there's not enough money in the budget to do that. So what has also been announced, just a couple of minor things, there's going to be a consultation on the meaning of plant and machinery launched in 2024. Capital allowances is super complex. There's all sorts of case law surrounding what qualifies and what doesn't. And one can only hope that this leads to some simplification, because it really is a minefield, even for those of us living it on a day-to-day basis. A very small point, but very relevant for businesses operating in the renewables sector. And I know some businesses that have joined today specifically in that sector, so this is in there for you. So the electricity generator levy has been abolished for projects commencing on or after the 22nd of November 23. So as of yesterday, and this was effectively a super tax that was brought in at 45% to tax renewable, electricity generating businesses. And so for new projects, that won't apply. Okay, so let's move on to R&D now. And R&D is a significant tax relief that we have in the UK, and it was brought in 23 years ago now, really to try and stimulate the R&D in the UK economy. It almost remained unchanged for about 20 years, and now we're looking at sort of effectively simplifying and improving it. So for many years, we've had the small or medium-sized scheme, the SME scheme, which gives you effectively a super deduction based on qualifying expenditure. And if you're loss-making, you can get a tax payable credit. For larger businesses, we've had something called RDEC, and that gives you sort of an above-the-line credit, which effectively gives you further tax relief. So what the government has been consulting on over the last 6 to 9 months is looking at merging these schemes, because they operate in different ways. And actually, if we can look to simplify it, that would be better. So what has actually been confirmed is that the simplified and improved scheme, so the merged scheme, will come into effect for accounting periods starting on or after the 1st of April 24. So some earlier measures in the consultation was talking about expenditure incurred after the 1st of April, but this does delay it slightly to allow taxpayers to prepare. Now, I think there are still calls in the industry for this to be delayed to allow companies to prepare, and even software providers. We're only 4 months away from these rules coming in, and they are some quite significant changes. So there were calls, but the government is still pushing ahead with the changes. So what are the changes? We're looking to merge the scheme, and effectively, what's going to happen is that all of it will move to an RDEC scheme rather than a super deduction scheme. There was an announcement yesterday where for the notional tax that's withheld will effectively lead to a slight benefit for loss-making companies, increasing from 15% to 16.2%. There's some clarification around where R&D is undertaken effectively with a chain of companies, in terms of if you are subcontracting R&D to somebody and then they subcontract a part of that to somebody else, who actually benefits from the R&D relief in there. And it is a very complicated and subjective area, so there again is some clarification announced yesterday in terms of who gets the benefits. And then the treatment of grant funded and subsidised projects has simplified, but again, that is still an area that is complex. So whilst I've just talked about merging the two schemes, for R&D intensive businesses, again, it was confirmed yesterday that there is still going to be a scheme much like the SME scheme. Now, this only applies to companies that their total expenditure, more than 30% of it is spent on R&D. Previously, it was announced that you were going to have to spend more than 40% of your total costs on R&D, but that's been reduced to 30%. Sorry, the light's just gone off. So actually, that's a really good move, and I think it will bring more companies into the more advantageous regime, where you're getting an effective tax credit of 27% rather than under the merged RDEC scheme of 18.6%. So I think what was also announced yesterday was there's a year of grace announced for the intensive R&D scheme. So if you're a company and one year you spend 35% of your expenditure on R&D and the next year you spend 25% and you're sort of yo-yoing over and above the 30% threshold, then actually you have that year of grace and you can continue to be in the intensive R&D scheme, which is obviously the more advantageous scheme. And I think that's really welcome, because a lot of these loss-making R&D businesses rely on the tax credit that they receive, and it's important to be able to forecast what you're going to be receiving on a pretty regular basis. A couple of sort of just tightenings up really going on. R&D claimants can no longer nominate third-party payees to receive their refunds. I think there were probably a few, not many, but the few companies out there who were helping companies to make their R&D claim, receiving the funds directly from HMRC and then perhaps not passing on what they should have done. So that's a welcome move. More resources are being applied to detect exaggerated or fraudulent claims. This does have an effect on genuine claims. What we are seeing is a significant increase in HMRC's review of R&D claims. And, you know, probably on a weekly basis, inquiries are coming in, and they are all a standard list of questions that even if that information has already been provided to the revenue, they are still seeking to ask those questions. So, you know, there are some less genuine claims out there, but I think, you know, putting more resources, hopefully it will mean that actually the inquiries are targeted based on the information HMRC have, rather than what they seem to be doing at the moment, which is sending out a sort of catch-all to every business. And then there's been further support announced for some other specific R&D industries. So just I'll sort of quickly whiz through this, because there's not an awful lot new in here, but I do have some news hot off the press this morning, some correspondence with the Treasury on some certain meanings. So what has previously been announced, and there's again no change to what's expected here, is that the audiovisual expenditure credit is going to replace the film, animation, high-end and children's TV credit, and then we've got a video games expenditure credit. So both of these schemes used to work in the same way as the R&D SME scheme, where you get effectively a super deduction on your expenditure. They are now all moving to an above-the-line credit scheme, effectively trying to mirror how the RDEC merge scheme works. So there's a clear move from the government in terms of tax credits to try and effectively align how they all operate in practice, which I think, you know, certainly for people doing their tax exams will make it much easier for them. So as I've just said, it's going to be calculated that R&D, that there is a slight increase in the benefit compared to now for animation and children's TV, but otherwise the rates remain broadly the same whilst the calculation method differs. There is an option to opt in slightly earlier, depending on where your production is in its sort of cycle. And obviously, if you're going to benefit from the higher rate, then that's something that you probably want to look at sooner rather than later. There are some, again, slight changes that have been confirmed in the autumn statement yesterday in terms of how much expenditure has to be sort of used or consumed in the UK. It was previously had to be within the EEA, but that's been removed post-Brexit and replaced with UK. There are transitional arrangements in terms of sort of theatre, orchestra, museum relief, if you're not concluded by that time. But again, they are quite nuanced. So if you are operating in that sector, it's probably worth delving into the detail in that sooner rather than later. So some technical changes. So what we were sort of concerned about here, certainly the profession were concerned about, was the revenues consultation on excluding capital expenditure. There is still no draft legislation published yesterday. That is still the old legislation that they published in the summer after the budget. So we're not really any further forward in terms of what their intention is regarding the exclusion of capital expenditure. And the revenue, hot off the press this morning on the sort of last bullet point, have confirmed that they have absolutely no intention to exclude productions from making a claim where the main focus is effectively sitting and watching the performance. What they are concerned about is immersive productions where, for example, in the West End at the moment, there's Monopoly Go. Actually, are you sitting and watching a performance, or are you taking part in it? And so there are, they want to make sure that immersive productions are targeted in the right way. There's some, again, slight nuances in terms of various different dates for elections that you have to be made, and some tightening up on some other conditions. Now, creative sectors generally, we don't have any further detail on the first one, which is the new information form to be used for all claims. Again, it feels as though what the government are trying to do is align the creative sector tax reliefs much more with the R&D tax reliefs. So at the moment, if you're making a claim for R&D since the 8th of August this year, you have to effectively pre-notify HMRC, and then you have to fill in a dedicated form which sits separate to the tax return, but must be filed before the tax return is submitted. And the feeling is that perhaps actually this new information form will mirror what's happening in the R&D world. And the clarification again we had from the Treasury this morning is the cost of goods or services provided between connected parties. What they've been talking about is making it an arm's length price. Some concerns were that it would be limited to cost of the SPV, but actually I think that's good news this morning. Again, a couple of things just to highlight: EIS and VCTs. There's significant tax relief for individuals who are looking to invest through EIS or VCTs. That was due to expire in 18 months' time, and it's been extended for another 10 years. Interestingly, it was allowed because of Brexit. A lot of these tax reliefs, when we were certainly in the EU, had to meet the EU conditions, and there was concern as to whether this would be one of the tax reliefs that got abolished. But because of Brexit, we're allowed to keep it. Just a couple of reminders of things coming in. So EMI share option schemes. Again, I think this is some simplification, which is welcome. At the moment, if you're granting an option to a new option to an employee, you have 92 days to notify HMRC. Otherwise, it will not be a qualifying option. Now they're aligning that with your normal annual return that you have to submit to HMRC every year, which is good news. So that's from 6th of April 2024. So if you're granting any options before 6th of April 24, the 92 days still applies, and it's really, really important that that you complete that notification. And then again, there was just a couple of small changes that are already in place. Let me just go back. Yeah, so there are a couple of changes that are already in place in terms of just some admin in respect of employees for EMI share option schemes. So there is never any budget without HMRC being given more powers to crack down on tax avoidance. So there's now a new criminal offence for promoters of tax avoidance schemes where they effectively fail to stop promoting them. There's a disqualification of directors involved in those companies, and you can go to prison for 14 years rather than 7 as a result. So the government are always looking for new ways to effectively put people off from doing things that they think they shouldn't be doing. So, and finally, again, nothing normal, but it's always an interesting point that Katy and I and Tim get asked about all of the time, which is, should I pay myself a salary or should I pay myself a dividend? And again, these slides will come round so you can have that information there. And as you can see, for a company that is paying tax at 25%, broadly paying yourself a dividend, there's going to be a 50.31% tax rate. If you pay yourself a salary, it's 49.03. And you can see for an additional rate taxpayer, it's broadly the same. There's about 1 percentage point in it. It traditionally was always more effective to pay yourself a dividend. And I think, now that, as these numbers show, that isn't always the case, and it depends on individual circumstances. So I think what we've got here is probably the new normal. I think corporate tax rates at 25% and the 40% and 45% will affect how this happens. So I think that's all from me. I'm probably going to hand over to Tim.
We've got a few questions coming in and a bit of time at the end for those who can stick on. So do fire any more in where you've got the tax experts available. So one, Mel, which you've just touched on there, is you've described 25% as the new normal corporate tax rate. Again, I'm asking you to look in your crystal ball. Is that the new normal? Will it go up? Will it go down? We've got an election and possibly a change of government. What do you expect to happen?
So I think on my crystal ball gazing, I think it will probably stay the same. And I think there's a number of reasons for that. So we've obviously had an increase only from the 1st of April this year. If you compare us to the G20, we're pretty competitive. Most other countries have rates at 25% or higher. So it actually puts us in a very good perspective from a G20 and what other countries are doing. Also, what we've got coming in is the global minimum tax rate, where effectively all of the G20 have signed up that there won't be a corporate tax rate of less than 15%. So I think, looking at any tax cuts is probably unlikely. There's probably no money for it either. And then I think finally, we've talked a lot today about the creative sector and the RDEC scheme, and that being a sort of above the line credit. Every time a change is made to the corporate tax rate, it has an impact on all of those tax credit claims. So I think if we have a change to the tax rate, the Chancellor's then going to have to change all of the associated rates with those schemes, and it just seems quite a lot of work to do that. So I think probably at the moment, I think we're sticking at a 25% would be my view.
Yeah, the worldwide trend seems to be a fairly consistent headline rate of tax, and then it's all about deductions and full expensings and move in that direction. So effective tax rates could be much lower. So a couple of questions coming in as we reach the end. A good one, but perhaps this is more a philosophical one than anything else. But I thought tax evasion was illegal and tax avoidance was legal. I think we've moved into a world of tax evasion, tax avoidance, and unacceptable tax avoidance. Mel and Katy, have you got any views on that?
Absolutely, Tim. And I think completely agree with the question that certainly when I started in tax, evasion was definitely illegal and avoidance was okay. I think we've had many sort of general anti-abuse rules, targeted anti-abuse rules introduced, and really what the government and HMRC are looking at is, are you acting within the spirit of the law? Now there is a viewpoint which is, if they wrote the law in a better way, then perhaps there wouldn't be any ambiguity. But I think all of these targeted rules are to try and encourage taxpayers to behave in the spirit of the law.
Yeah, we live in reasonably uncertain times. Katy, what's your perspective from the private client sense?
Yeah, just to add to that, I was going to say that the bulk of the work that I think we do as tax advisors is helping clients understand the rules and maximising all the reliefs and the exemptions and the thing that's already there to pay the right amount of tax.
Yeah, I mean, there are all sorts of clever plans out there which are not evasion, but certainly are not what the law was intended to do, which sort of drifts into that unacceptable avoidance camp. So life is difficult. So look, on to the corporate tax rates again. We've got a question in about the 19% band and the 50k limits of the small company band, and what happens when you own more than one company. At what point could that be lost? Mel, I think that's a question for you.
Yeah, so effectively any associated company, that band is reduced by. So it used to be just if you were in the same group, but now if you're associated, which effectively means you control two different companies, not in a group, then those bands are reduced accordingly. So, you know, in the vast majority of our client base, Tim, most companies are paying at the 25% rate, either because they're profitable or because, you know, it doesn't take many companies in a group to push you over that threshold.
Yeah, so lots of let's say property developers might have many SPVs. So you might do a different development through a different company. You'll divide your limits down and you're going to be straight into the 25% tax rate. So the 19% tax rate for smaller businesses really are for the very small businesses or the standalone companies.
Yeah, and I think just on that point about sort of associated companies, it's because the definition's been widened. I'm thinking particularly about your comment on SPVs. It does push many more businesses into the quarterly instalment regime as well, which is if your taxable profits are above 1.5 million divided by the number of associates. So, you know, there are lots of knock-on consequences to be aware of with associated companies.
Yeah, so there's a request which we may do in the follow-up, just in the salary versus dividend, to include the other tax brackets as well. So we focused on the 45% tax bracket. The same story is told at the other tax brackets, but we'll include those numbers. That's easy to do in what we send round, so we'll do that one. Somebody's absolutely pointed out that salary sacrifice is a form of tax avoidance. It absolutely is, but doesn't sit in the unacceptable tax avoidance if it's fairly vanilla. One question around, will we be sharing the slides? We absolutely will, and we'll add in those extra tax rates so people can see those. Now, I did promise my fellow tax partners that I'd only ask questions that I knew the answer to, and we've got one that's come in from the audience that I don't know the answer to. So we may follow this one up in the slides afterwards. So I'm gonna be daring and ask Mel a complex question on R&D. So interested in the benefits of the decision takers in R&D tax credits. Is it now clear the ultimate decision taker influencer receives the R&D tax credit?
I don't actually know the answer to that either, Tim. Yeah. So the devil's in the detail on this, and you know, we really need to sit and go through the draft legislation. So we can follow up on that one.
Yeah, we've got why Mel and I don't know the answer is we have a specialist R&D team, so we'll see what insight they've got and we'll include that in the follow-up afterwards. So I think we were billed to run for 45 minutes. So I've got just a couple of other questions that came in, and then we're probably just about at time. So one for you, Katy, right back to the beginning, which was around making tax digital, which is a regime that's been talked about, and I think people have largely ignored as it's been delayed and delayed and delayed. When is it going to start meaning something to our sort of clients, owner-managed businesses, and later perhaps companies?
Yeah, so I think it's going to start meaning something soon. So for income tax self-assessment, it has been subject to delays in terms of the introduction. So making tax digital has already been introduced for VAT and is working well, but for income tax self-assessment, so introduction from 2026 for self-employed individuals and those with property income. So what that actually means in practice is that you're going to have to keep digital records. So that could be something as simple as a spreadsheet, or possibly on accounting software or an app. And you have to keep that digital record, and you have to submit a quarterly report to HMRC. So you submit the quarterly report to HMRC, and then at the end of the year, you submit an end of year statement to kind of tie everything together. The tax payment isn't immediately going to change to quarterly payments. That's still going to be the 31st of January after the end of the tax year, but eventually it will move more into that regular tax payment.
Yeah, so at the moment, our private client team, our 50 or so people that are preparing tax returns, are expecting a busy November, December, January. We will be going into a world where it's not quite 4 tax returns a year, but the work's going to be throughout the whole year. So it's a new world we're living in. A lot of the rest of the world have done it in digitizing their tax system. Yeah. So we're just up to our 45 minutes. So there's a couple of open questions for what we'll do. We'll deal with those in the follow-up. It remains for me to thank our panelists after a sleepless night trying to absorb all the detail after yesterday afternoon. So thank you, Katy. Thank you, Mel. Thank you to all the attendees. I think we had almost record numbers in today. So thanks for joining us. The slides and feedback and a Q&A log will be sent around afterwards, and we hope to see you at future webinars in the rest of the year. Thank you.